Here's the thing about starting over.
You don't get to bring the knowledge. You don't get to keep the pattern recognition, the scar tissue from bad trades, or that gut feeling that stopped you from buying something stupid in 2022. If I had to start over in 2026 with a clean slate and build a portfolio from scratch, I'd ignore 90% of what the finance industry tells you to do, not because it's wrong, exactly, but because it's designed to keep you busy, keep you trading, keep you thinking you need more. The truth is simpler and far more uncomfortable. 3 ETFs, that's it. And if you stick around, I'll explain why more choice is actually making you poorer, why the average investor underperforms a coin flip, and why the financial services industry has spent decades convincing you that simple is somehow irresponsible. Let's start with what most people do wrong. They open a brokerage account, they Google best ETFs, and they end up with 17 different funds because each article says something different. Growth ETFs, value ETFs, dividend aristocrats, emerging markets, small cap, international developed, sector rotation strategies. It sounds sophisticated. It feels like you're doing something important. But here's the uncomfortable truth. Studies from Dalbar, Morningstar, and Vanguard all point to the same conclusion. The average investor underperforms the market by 2 to 3% annually, not because they're stupid. Because they're human. They buy high when everything feels safe. They sell low when panic sets in. They overweight whatever sector is hot. They chase performance. And most devastatingly, they pay fees they don't even realize exist. So if I were starting from zero today, December 2025, with everything I know about how markets actually work versus how we want them to work, I'd build around 3 funds. Just 3. And before you think that's too simple or too boring, consider this. Warren Buffett, who has access to every hedge fund manager, every private equity firm, every sophisticated strategy on earth, has instructed his estate to put 90% of his wealth into a single S&P 500 index fund when he dies. Not because he lacks options, because he understands something most investors fight against. Simplicity wins, complexity costs. And time in the market beats timing the market so consistently that it's almost boring. The first ETF I'd buy is VTI, the Vanguard Total Stock Market ETF. This single fund owns every publicly traded company in America, all of them. The giants like Apple and Microsoft, but also the mid-sized companies, the small caps. The weird little industrial firms you've never heard of that make components for things you use every day. When you buy VTI, you own about 4,000 companies. The expense ratio is 0.04%. That means for every $10,000 you invest, you pay $4 per year. Compare that to the average actively managed mutual fund charging 1% or more, which means $100 per year on that same investment. That difference sounds trivial until you run it forward 30 years. A 1% fee difference on a $100,000 investment compounded over 3 decades costs you over $70,000 in lost returns. The fund manager didn't steal it. Mathematics did. But here's what VTI really gives you. It's not stock picking. It's a bet on American capitalism itself. You're saying that over the long run, the American economy will grow, companies will innovate, productivity will increase, and stock prices will reflect that. You don't have to guess which companies. You don't have to know if artificial intelligence will be dominated by NVIDIA or some startup that doesn't exist yet. You own everything, and the index automatically reweights based on market capitalization. When a company grows, it becomes a bigger part of your portfolio. When it shrinks, it becomes smaller. No effort required. And historically, this approach has delivered about 10% annual returns before inflation over the past century. Not every year. Some years you lose 30%. But zoom out over any 20-year period, and it works. The problem most people have with VTI is that it feels too easy. There's no story, no thesis. No cocktail party anecdote about how you identified an undervalued sector before everyone else. It's the investing equivalent of eating vegetables and going to bed early. Effective, but not exciting. And that's precisely why it works, because investing isn't supposed to be exciting. Exciting is how you lose money. Exciting is how you overtrade. Exciting is how you convince yourself that you've spotted something the entire market missed, when really you're just rationalizing a gamble. The second E to FI'd by is VXUS. fund.THE, VXUS, FI'd, the Vanguard Total International Stock Market ETF. This fund owns everything VTI doesn't. About 8,000 companies across Europe, Asia, emerging markets, everywhere outside the United States. The expense ratio is 0.08%, still absurdly cheap. Now here's where it gets interesting, because international stocks have underperformed U.S. stocks for the past 15 years, dramatically. If you put money into VXUS in 2010 versus VTI, you'd have significantly less today. So why own it at all? 2 reasons. 1. Valuations. International stocks are trading at much lower price-to-earnings ratios than U.S. stocks. European and Asian companies are cheaper relative to their earnings. That doesn't mean they'll go up tomorrow, but it suggests better long-term potential returns from current levels. 2. Diversification isn't about maximizing returns. It's about surviving the times when your primary bet goes wrong. The U.S. market has dominated for 15 years. Before that, international markets dominated for a decade. These cycles reverse often when you least expect it. And when they do, having international exposure means you're not entirely dependent on American exceptionalism continuing forever. But there's something deeper here that makes VXUS essential. Currency diversification. When you own international stocks, you're not just exposed to those companies. You're exposed to euros, yen, pounds, yuan. If the dollar weakens, your international holdings become more valuable in dollar terms, even if those stocks don't move. It's a hedge most people don't think about. And in a world where the U.S. is running trillion-dollar deficits, where the debt-to-GDP ratio keeps climbing, where foreign governments are slowly reducing their dollar holdings, currency risk is becoming less theoretical. The split I'd use is 70% VTI, 30% VXUS. That's roughly proportional to global market capitalization. The U.S. represents about 60 to 70% of global stock market value. So this allocation tilts slightly toward home, which makes sense given we earn in dollars, spend in dollars, and retire in dollars. Some people prefer 50-50. Some go 80-20. The exact number matters less than having some exposure to both, because nobody knows which geography will outperform over the next decade. Now here's where most people would stop. 2-fund portfolio. U.S. stocks, International stocks, done. And honestly, that works. But there's a third component that changes everything when things go wrong: bonds. Specifically, BND, the Vanguard Total Bond Market ETF. This owns over 10,000 U.S. investment-grade bonds. Government bonds, corporate bonds, mortgage-backed securities, the full spectrum of fixed income. Expense ratio 0.03%. Let me explain why bonds matter, because this is where the narrative around investing gets deliberately confusing. Stocks are ownership. You own a piece of a company. If the company does well, you do well. If it fails, you can lose everything. Bonds are lending. You loan money to a company or government, and they pay you interest and eventually return your principal. The returns are lower, but the risk is lower. In a normal environment, stocks might return 8 to 10% annually, while bonds return 3 to 5%. So why bother with the lower return? Because every few years, stocks don't return 8 to 10%. They return -30 or -40. And in those moments, bonds usually hold steady or even go up, because when people panic about stocks, they flee to safety. Bonds become that safety. This isn't theory. Look at 2008. Stocks dropped 37%. Bonds were up 5%. Look at 2022. Stocks dropped 18%. Bonds also dropped, which was unusual, but they dropped less. The point isn't that bonds always protect you. The point is that owning both stocks and bonds smooths out the ride and prevents you from making the catastrophic mistake of selling stocks at the bottom because you couldn't handle the drawdown. Here's the uncomfortable math. If your portfolio is 100% stocks and drops 40%, you need a 67% gain just to get back to even. That's not 40%. It's 67 because you're starting from a smaller base. But if your portfolio is 70% stocks and 30% bonds, and stocks drop 40% while bonds stay flat, your total portfolio only drops 28%. You need a 39% gain to recover. That's the difference between taking 6 years to recover versus 3. And psychologically, a 28% drop is survivable. A 40% drop makes people sell, lock in losses, and never come back. So the allocation I'd use, starting from scratch in 2026, looks like this. If you're young, say 20s or 30s, 70% VTI, 20% VXUS, 10% BND. If you're in your 40s or 50s, 60% VTI, 20% VXUS, 20% BND. If you're nearing retirement, 50% VTI, 15% VXUS, 35% BND. The older you get, the more you shift toward bonds, because you have less time to recover from a crash. It's not exciting. There's no alpha generation, no market timing, no clever repositioning based on Fed policy. It's just math and human psychology working together. Now let's talk about what you're giving up by choosing this approach. You're giving up the chance to beat the market. You're giving up bragging rights. You're giving up the thrill of picking individual stocks and watching them soar. And statistically, you're probably gaining 3% per year in relative performance, because that's how much the average investor underperforms by trying to do those things. Think about that trade. You sacrifice the emotional high of potentially beating the market in exchange for almost certainly doing better than most people who try. That's the bet. Boring wins. But there's a darker side to this that the finance industry doesn't want you thinking about too clearly. Every product they create, every new ETF, every thematic fund, every actively managed strategy exists because it generates fees. The more products you buy, the more they make. Simplicity is their enemy. If everyone just bought 3 funds and held forever, there'd be no trade volume, no advisory fees, no fund launches, no wealth management industry. So they create narratives. They tell you that emerging markets are about to explode, that technology is a secular growth story you can't miss, that value stocks are due for a comeback. Some of those narratives will be right. Most will be wrong. And you'll never know which is which until after it's too late. There's also the uncomfortable reality that this strategy requires you to do nothing. That's harder than it sounds. In 2020, when the market crashed in March and everyone said this time was different because of the pandemic, doing nothing felt insane. In 2021, when meme stocks and crypto were making people rich overnight, doing nothing felt like missing out. In 2022, when inflation spiked and everything dropped, doing nothing felt reckless. But the data is clear. Investors who did nothing, who just held their boring 3-fund portfolio, outperformed almost everyone who tried to react, reposition, or get clever. The hardest part of investing isn't finding the right funds. It's sitting on your hands when your brain is screaming at you to do something. Let's zoom out to the bigger picture, because there's a philosophical question buried in this approach. If markets are efficient, if all available information is already priced in, then stock picking is just gambling with a thin edge. The only reason broad index funds work is because enough people are still trying to beat the market, researching companies, trading actively, and in doing so, they keep prices roughly accurate. But what happens if everyone gives up and just buys index funds? Does the market stop functioning? Do prices become disconnected from fundamentals? This is called the indexing paradox, and nobody knows the answer. We're running an experiment in real time. As of 2025, passive index funds hold about 40% of U.S. equity market share. That's up from 10% in 2000. At what percentage does the system break? 50? 70? Or maybe it never breaks, because as soon as inefficiencies appear, active traders step back in to exploit them, which keeps everything balanced. There's also the question of what this strategy assumes about the future. It assumes that stocks, over the long term, will continue going up. That American capitalism and global capitalism will keep generating wealth. That companies will keep innovating, that productivity will keep improving. That the next 100 years will look roughly like the past 100, but that's not guaranteed. Japan's stock market peaked in 1989 and didn't return to that level until 2023. 34 years. If you'd retired in Japan in 1990 with a stock-heavy portfolio, you'd have been destroyed. So the 3-fund portfolio isn't risk-free. It's just the lowest risk approach to capturing equity returns if you believe the future will reward ownership. Here's what I'd do differently from most advice you'll hear. I wouldn't rebalance constantly. Rebalancing is when you sell what's gone up and buy what's gone down to maintain your target allocation. It's sold as disciplined, but it also triggers taxes and creates drag. I'd rebalance once a year, maybe at tax loss harvesting time in December. I wouldn't check my account every day, because the more you look, the more likely you are to meddle. I'd set up automatic contributions, whatever amount I could afford monthly, and let dollar cost averaging do the work. I'd ignore every headline about crashes, corrections, and bear markets because they mean nothing unless you sell. And I'd never, ever try to time getting in or out because even professional hedge fund managers can't do it consistently. The final piece that makes this work is time. Not timing, time. If you're investing for 30 years, what happens in year 1 barely matters. A 50% crash in year 3 is a buying opportunity, not a disaster, because you're adding money at lower prices. The sequence of returns matters more than the average return, but only if you're near retirement. For young investors, volatility is a feature, not a bug, because it creates opportunities to buy cheap. This is why the 3 fund portfolio works best for people who can commit to decades, not months. So if I'm starting over in 2026, I'm buying VTI, VXUS, and BND. I'm allocating based on my age and risk tolerance. I'm contributing regularly. I'm ignoring the noise. And I'm accepting that this approach will never make me the smartest person in the room. It won't give me stories to tell. It won't feel like I'm doing something important. But 30 years from now, when most active investors have blown themselves up chasing returns, when most people have traded themselves into underperformance, this boring, simple 3-fund portfolio will have quietly compounded into something substantial. The uncomfortable truth is that investing isn't a game you win by being clever. It's a game you win by not losing. And the easiest way to not lose is to stop playing the game everyone else is playing. 3 funds, low fees, long time horizon, that's it. Everything else is just noise designed to separate you from your money. The question isn't whether this approach will beat the market. It won't. The question is whether you can accept that beating the market isn't the goal. Surviving long enough to capture the market's returns is the goal. And that's a very different game. Claude is a I and can make mistakes. Please double-check responses.